You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. I'm very happy to hear that music once again because that means it's back. Options Bootcamp is back. My name is Mark Longo from theoptionsinsider.com. As well as, of course, from the ever-exciting The Options Insider Radio Network. You guys have been hitting us up forever. When are we going to get Bootcamp back on a regular rotation? We were able to squeeze some kind of quick ones in for you at the end of the year, beginning of the year, as well as a quick little coronavirus pandemic-inspired episode that Dan and I did a little while ago. You guys want it back in your lives on a regular basis. I can't blame you, but I'm pleased to say we are back, at least for the foreseeable future here on the old program. Probably heard some familiar names over there as well. Got our old friends from NASDAQ joining us back on the program. Miss Jill not joining us this episode, but we'll see if we can round her up there to join us on the show. But you know who is joining me today? Of course, our old friend, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, as well as the author of many seminal options tomes out there. Mr. P, welcome back to Options Bootcamp, sir. It has been too long.
Hey, my white-hatted counterpart. How are you, man? Good to hear from you.
Has it been as crazy for you guys over there as it has been for us since the last time we chatted, sir?
Yeah, it's been really great. Our students are really, really engaged in the markets, and a lot of them seem to be doing pretty well, and no complaints, all good over here.
That's good to hear. Yeah, these are certainly crazy times, certainly difficult times if you don't know what you're doing out there. So glad to hear you're helping the folks through these crazy, turbulent markets. And I mentioned no Jill this episode. Doesn't mean we don't have a NASDAQ hot seat, listeners. And filling it today, we have a newcomer to the program. He is Tony ZHANG, the chief strategist over there at OptionsPlay. Tony, welcome to the Options Bootcamp program.
Thank you so much for having me, Mark. Great to be here with Dan. Haven't spoken to you guys in a while, but glad to be here, especially in this market volatility. A lot of clients asking for questions as to how to go about trading this, so glad to be here.
Well, Tony, as a first-timer, why don't you go ahead and give our audience a little bit of an overview of your background in the options and derivative space, as well as what the heck it is you guys do at OptionsPlay.
Yeah, sure. So my name is Tony ZHANG. I'm the chief strategist here at OptionsPlay. I'm one of the co-founders of this company. We provide technology, education, and professional services for institutions who are basically looking to grow their options business. We started this company about 7 years ago as just purely a technology firm. We were trying to build the best user experience for options traders because at the time we really just thought option chains weren't quite enough for most beginners to get started. We wanted to make an experience that was a little easier and guided. And so we tried to create a better user experience for options trading, and that's really how Options Play was born. And as a result of that, naturally, we started getting into educating both retail and institutional customers as to how to utilize Options Play and best practices for option strategies. And now we provide professional services for all sell-side wealth management exchanges globally to help them market options as an asset class.
There you go. And if our listeners, they want to access your information and your offerings, can they go directly to Options Play? Are they going to get it through their brokers? Is it a combo of both? How do they get access to it?
It's a combination of both. So some brokerage firms, and quite a few of them, offer it through their platforms such as Merrill, Schwab, Fidelity. But you can also go directly to optionsplay.com and subscribe to Options Play. You're going to get some additional services like our trading ideas, our education, if you go directly through optionsplay.com.
There you go. So cut out the middleman. Optionsplay.com is the place to go. Meanwhile, it's time for us to go right on into our first segment. It is time for some options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me?
All right, I've said it before, I'll say it again. I love doing this show because it always feels like the 4th of July here whenever we're doing this program. It doesn't matter that it's a cold, actually snowy day. It's like a January day in Chicago here today. So much snow, there was a 60-car pileup downtown Chicago. How crazy is that? Never see that, listeners. So that's the kind of conditions we're dealing with here. Not to mention, of course, the broad macro conditions that are plaguing everyone out there right now. But a little bit of the old options drills and the options boot camp sounds go a long way towards making you think it's 4th of July, at the very least, Flag Day out there. But of course, on the last episode Dan and I did together, kind of broke down some interesting trade ideas that were very useful in these extremely volatile markets. It's been a little bit of time now, not a ton, about a month and change, but a lot has happened in the broad marketplace. So maybe, Dan, let's start there. The last time you were on the show, you kind of had your top 3 strategies you were recommending in the marketplace right now. One of them, which I think we both joked about, which was kind of crazy, was a long straddle. And, we've always talked very dismissively about that strategy in the past because it's an extremely difficult strategy to pull off effectively. Even pros have a hard time making long straddles pay off. But that's how volatile the markets were. The last time we chatted, you could actually go out and buy a straddle and pick your underlying, and there's a good chance it was going to pay off for you. Just on a pure directional basis, forgetting everything else out there. So I'm curious, Dan, are those conditions still around? Have you updated? Have you amended your list of your recommended trading strategies out there right now? And also, in general, kind of catch us up. What's been coming across your plate? What are your clients and mentees? What are they asking about right now in these environments, sir? A lot to unpack there.
Yeah, the thing is the market just keeps changing with this. I mean, when did we talk last? Like 2 weeks ago, right? Yeah, I mean, I would say, I think, as I recall, the strategies that we talked about were selling puts, buying calls and puts on breakouts, and straddles. And those still are some of the more viable strategies. Some of them, I would say that two out of 3 of those got a little bit tougher. And I'm adding to that list, time spreads have been working out really, really well in our group coaching class. Coach John talks about time spreads all the time. They're about the best spec play you can make right now. But there's kind of like how in wine country there's microclimates. Like you walk 10 feet away and it's a slightly little different climate. That's kind of what we got in this market. Like next week it's kind of like a different micro market.
Yeah, it is very much a micro market. I like that term, micro market. I may have to borrow that, sir. Hopefully your licensing fees are reasonable. And I did look it up. It was pretty much exactly a month ago. That's what I thought last time you and I chatted. It was March 17th. So we're recording this, listeners, on what used to be tax day, April 15th. No more. You can thank the pandemic for that. I suppose one of the few silver linings of this broad global pandemic. We all have a little bit more time to pay our taxes out there. So, Dan, sounds like time spreads are kind of your go-to trade du jour right now, sir.
Yeah, they've been working really, really well in our group coaching class.
There you go. Time spreads. We'll get into that more in a little bit. But first, before we get to that, Tony, catch us up. Obviously, you've never been on this program before, so a lot to catch us up on. But in general, you guys interact with a broad spectrum of the retail. And as you mentioned, more and more of the institutional paper and order flow out there as well. What are you seeing broadly from your various clientele out there? What are they looking for? What kind of strategies are they coming to you for? Is it just, hey, vol's high, we want to harvest some premium? Is there something else afoot? What are you seeing out there at Option Play right now, Tony?
So first and foremost, I would say the most common question that we're getting right now is, are we currently in a bear market rally? Is this going to sell off again? That's I think, top of mind for most options traders, because direction is still by far the most important thing. And then you get into volatility and whether it's time to sell or buy. I think it's great that you guys mentioned the straddle strategy. And I think, even in your notes, you discussed that it's a rare conditions. It's rare when straddles work. And I don't think we're still in that environment right now where straddles could still work. But as Dan said, time spreads is definitely the strategy that we're predominantly using right now. We're also doing some selling of credit spreads, especially as the markets continue to rally. We are trying to fade that rally right now using call credit spreads. So those are the types of clients, those are the types of strategies that we're predominantly focusing on. Buying calls and puts right now, I think, is a little tougher at the moment, just because implied volatility is still fairly high. And volatility is slowly pulling back, and vol is subdued right now. So, those are the types of strategies that we're predominantly looking at and fielding the question as to where are the markets headed going forward.
So your traditional time spread use case is going to be, let's say, hypothetically, you come out to XYZ stock or underlying. Typically, you go out a month, maybe two. Let's just say, for the sake of an argument, you go out and buy a 2-month at-the-money call, and you turn around and sell the 1-month at-the-money call against it. Gives you a little bit of bang for your buck. You hope for a little quiet time in the near term, then you hope for a little bit of maybe blowing the doors off in the longer term. Is that your typical structure you guys are recommending as well? Tony, do you guys have a particular maybe options play flavor of the time spread you guys like to recommend? Maybe, 3 months versus 1 month, or a little bit out of the money. How do you guys normally recommend time spreads?
So if we look at the markets over the last few weeks, we've generally been going out about 2 to 3 months to buy, because the implied volatilities on those are significantly lower. And then we're selling really short dated options, usually weekly options, no more than 1 to 2 weeks out. For a lot of the trades that we're looking at, the options that we're buying may be trading at half the vol of the weekly options that we're selling. So we're really trying to take advantage of the short, or the extremely elevated premium in the very short dated options to offset, the longer dated implied volatility.
And Dan, is that a structure you like to utilize as well, going out, let's say, 2 to 3 months and then turning around and selling the weeklies? Or is there perhaps a different, a market taker flavor of time spread, if you will, sir?
No, we're on a very, very similar page. To me, the important thing is, first of all, I love selling the weeklies. I only like to sell time spreads when it's statistically advantageous, when I can sell a higher implied volatility than the one that I'm buying. And then, what I do is, who the heck knows where this market's going to be in 2 or 3 months? So I prefer to keep the long dated option as short term as possible, like, little kind of hit and run sort of scenarios. But I also want to make sure that I'm buying a low volatility, one that's less likely to get crushed, or if it does get crushed, not fall quite so much. So, I just kind of go through the term structure volatility. If the front expiration's high, that's the one that I'm going to sell. And then I go to the next consecutive expiration. If it's lower, good sign, but let's see if I can do a little better, maybe skip an expiration. If it's yet lower, good sign. Can I do a little better? Let's skip one more expiration. And then, presuming we have weeklies, I tend to stop about there. I tend to go to be buying 3 to 4 weeks tops, if possible.
And I know we're going to get this question. I'm just going to head it off now. In fact, I haven't checked the chat. Maybe it's in the live chat already. But I know we're talking time spreads. We're saying it's a favorable environment. We're talking about structure. They're going to ask us, what are some underlyings that you're seeing very favorable setups for with this roughly 3-month versus weekly setup? So, Tony, I'm going to save us time on the next episode. We're just going to answer it now. What are some of the more popular underlyings that you're seeing people trading time spreads in right now effectively?
So, at least for our customers, we're predominantly looking at, where we see the disconnect in this particular market. And right now, the consumer discretionary sector is the one that we're focusing our attention on, looking at the high frequency credit card data, looking at where the markets are currently trading. We think that is a sector that is a little I think mispriced right now, and we think there's some opportunities to short some of the weaker names in that particular space. So first of all, as far as a sector, we're focusing more so on the consumer discretionary. Energy is also an interesting sector at the moment to still continue to look at. There are some strong names that I think are starting to head lower, like Chevron, like Exxon. But in the consumer discretionary names, we're short names like General Motors, we're short Nike, we're short quite a few different names. But again, what we're not necessarily outright short. We're short through selling call credit spreads, which, we can discuss here in a few moments as to why we find that to be the most optimal structure at the moment.
Interesting. I mentioned listener questions. We get to a few of those in a minute here, listeners. But you mentioned energy as well there, Tony. And Dan, I know the last time you and I were chatting together about a month ago, I know you were pretty interested in harvesting some downside premium in USO. USO has been moving and shaking. Broad WTI and crude have been moving and shaking quite a lot. We've seen big announcements and then big rallies and then immediate sell-offs out there in the broad energy space as OPEC is trying to figure out what the heck it's up to. And our domestic producers are as well. I'm curious, Dan, is energy still a sector you're interested in? Is that an area where you're still harvesting the old risk premium?
Dude, that's some crazy stuff, man. Yeah, I am. I'm invested long-term in some USO that I acquired from selling puts happily, but also doing some trading of it on the side. That's been the best spectator sport in the entire market for the past couple of months, notwithstanding the coronavirus crisis. So yeah, I've been doing a lot of that.
I like that. The best spectator sport in the market right now is trading options on USO. Producer, tweet that out. I like that. That's a good one. Good one to share with the masses out there. Speaking of the masses, we're doing something a little bit different, listeners. So I want to make sure we're doing a little bit shorter episodes so we can get them out to you on a regular weekly basis as opposed to the kind of bi-monthly ratio 1 hour episodes we were doing. So I want to make sure we sneak some of you guys in. But really quickly, Tony, before we move off the options drills, because you have a lot of questions to get to as well. Something you just touched on earlier, I think it's worth repeating on a program like this. You mentioned when you're going short and underlying directionally, you don't like just going out and naked hammering away at the calls. A lot of risks inherent in that. You prefer call credit spreads. Why don't you walk our listeners through why you go that route rather than just the straight up call by itself?
So the call credit spread, so there's two dynamics that we're looking at. One, we're looking at where implied volatility is, and it's clearly elevated, which generally speaking is a better environment to be selling premium in, right? So that whether we're selling call credit spreads that have a neutral or bearish view, or put credit spreads if you have a neutral / bullish view. But given the current market environment, the other thing that we're also taking a look at is skew. And what's really interesting is that if you look at selling a call credit spread, where you're selling the at the money call and then buying back an out of the money call, those out of the money call options are trading at fairly low implied volatilities, which actually makes selling call credit spreads a better strategy than selling put credit spreads, if you're directionally neutral, simply because right now, if you look at out of the money puts, they're actually trading at a higher implied volatility than the at the monies, which negates some of the effects of the high implied volatility that you're trying to sell to begin with. So, that's why right now, from our perspective, first of all, just because, we don't exactly want to be fighting the Fed right now in terms of taking on shorts. It's hard to continue to press shorts by buying puts right now, so we prefer selling call credit spreads, but also just because of the skew, it actually works in our favor at the current moment.
And your questions usually work in our favor. Let's see if we can squeeze a few of you on as well with a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
You should see me here in the studio, listeners. I'm waving my flag, got my sparklers going. So patriotic, the music for this show. Of course, welcome to Mail Call, the portion of the show where you guys take the reins, your questions, your comments, your insights, your snide remarks for Mr. P. We forward those to him, don't worry. Let's kick it off here. Here we go. Oh, I like this handle. El Diablo, the devil himself writing in. He wants to know, have you seen a lot of options brokers going down in this market? I know Robinhood got most of the press. Any other majors? Well, a lot to unpack with this. You said going down, I'm assuming you mean outages, not out of business completely, because we haven't really seen the latter of that. But you're right, there have been some outages, and you're right, Robinhood kind of took the lion's share of the umbrage there. I'm not sure if I would classify them as a major options broker. I'm sure some other brokers may take umbrage with that classification there, but they certainly got the lion's share of the press about going out. We have seen some other scattered outages, but nothing along the lines that we've seen, at least that I've seen over there in Robinhood, where it was multiple days they experienced similar issues. Tony, you guys are hooked into a lot of the major options brokers out there. I'm curious, have you heard a lot of complaints about downtime out there? Or have you been surprised at how up and available the platforms have been in all these crazy, tumultuous markets?
I would say I'm actually surprised, but also, I think this is just due to years and years of investing in technology infrastructure that's allowed most of the major brokers to stay up the entire time. There was a bit of slowdown on some of the really volatile days in terms of getting quotes and putting orders in, but nothing in terms of like the outages that we saw at Robinhood.
Yeah, thankfully, we haven't seen. And these are, as I mentioned on other shows and on this one a little while ago as well, our last episode, these are somewhat unprecedented waters, listeners. We're completely and totally electronic in the options market for the first time, and indeed in the equity market. So no one really thought we would be under these circumstances where we would all go electronic. So somewhat unprecedented and a high level of volatility and everything else. Huge stresses on the marketplace, and yet still, for the most part, managing a lot of uptime, which I think is fairly impressive. All right, we got a strategic question here coming in from iBot. iBot wants to know, is this a good time for stock substitution strategies? We talked about these many times on the show in the past. A lot of our friends on the network as well, like Brian over there on Options Playbook Radio and others, big fans of the stock substitution strategy. This usually involves listeners buying an in-the-money call option somewhere, depends on how you set it up, usually at least 3 to 6 months, sometimes even longer, out to a year or more, depending on your flavor of stock substitution that you like. But that's usually what is meant by stock substitution, buying a higher delta in-the-money option, typically 70, north of 70 delta, 70 to 85 or so, maybe in that range, and doing that for a lesser outlay in order to get most of your exposure to the underlying at a much lower cost. Of course, that comes with some challenges. Mr. P, I'm curious for you. Have you been talking to your mentors and your mentees, I should say, out there right now? Is this something you've been talking about a lot? Because there's obviously issues with that as well. Obviously, spreads are going to be wide out there, and also the Vega out there is going to be a little bit rich. So is this a time when you've been recommending stock substitution to people, sir?
I have not. I just feel like, even if you go back to, we're talking probably about buying some really long-term stuff, right? Like leaps, right? Even if you go back pretty far, I'm looking at the volatility in the January 2022 Apple. It's a 32 vol. I look at the chart and see what just the normal vol it used to be. And, it was like 10, so you're just buying some gigantic Vega options at an extremely high volatility that, God willing, is not going to be there in 2 years. So, no, I don't like it at all. Yeah, I don't like it at all. Just buy the stock and manage your risk and don't pay all that absurd premium.
I like you, Dan. You always mince your words. Tell us how you really feel, sir, about stock substitution right now.
Yeah, but your point, too, about the spreads being wide, too, that's a gigantic, holy crap. You go back, just looking at Apple's about as liquid as it gets, right? We're talking $1.60 wide and such on those leaps options. That's less than 1%, but do you really just want to start your trade a little less than 1% in the hole? That's crazy, man. Crazy.
Yeah, these bid-ask spreads alone in these markets are getting better, but still, these bid-ask spreads alone will hurt you if you're just lifting offers and hitting bids, particularly out there in the leaps. Tony, same question for you. Are you on the same page as Dan and I out there that you're not a really big fan of stock substitution, or maybe point counterpoint? Maybe you're a huge fan of it. You love it right now, sir. How do you come down on this debate?
So I haven't really traded a lot of stock replacement strategies. We predominantly, at least in this particular market, have been talking a lot about selling put options, especially on stocks that you want to purchase. The high implied volatility right now for many of the big name stocks, and I'm talking about, the top 100, 200 names by market cap, you're collecting 1.5%, 2% of the underlying stock price in 3-4 weeks selling put options. That's a strategy that we would much prefer customers use if they're trying to acquire stocks. The vol that you're paying for those calls, I think, like you said, it's just too expensive. As far as a comment on liquidity, we actually track liquidity of all the optionable symbols, and during normal conditions, we see about 400 names or so that we would consider liquid, with about 150 that we would consider very, very liquid. Right now, that list is only about 180 names, so less than half of what we would consider liquid names for trading. And the very liquid names is about 60 to 70 right now. So liquidity is really just not quite there, even though we've stabilized a little. So, right now we're predominantly selling puts.
All right, a lot to unpack there as well about liquidity. Unfortunately, listeners, that music means we have to get out of here, at least for right now. But don't worry. We know a ton of you have questions. Well, we're coming right back pretty soon. So just hit next on your podcast device of choice there to answer a whole bunch of your questions in a very special pandemic-themed mail call episode. Before we go, they go back around the horn. Tony, as our first timer, we'll start with you. We kind of touched on it at the top of the show, but if folks want to kick the tires and light the fires over there in options play land, sir, where should they go? What should they do?
They should go to optionsplay.com. We have an access to a free 30-day trial. You can test everything out, our platform, our education, our ideas, and then decide whether it's suitable for you.
There you go, optionsplay.com, or maybe your broker of choice. You may already be using them and not even know it. So check out the tools you're using over there on your platform. If you like them, maybe you have Tony to thank over there. And Mr. Black-Hatted One, if I want to call you up or email you to talk about stock substitution or selling puts in USO or all the other fun stuff you're up to over there. I know you're a huge fan of stock substitution. Where should I go? What should I do, sir?
Oh, there's a couple things. I mean, I've actually been producing a few YouTube videos to kind of help people through this market. Our channel is just, youtube.com/market taker mentoring, all one word, no dashes or anything like that. youtube.com/market taker mentoring. So, yeah, I mean, check it out. Maybe you find something helpful there.
Check them out on the old YouTubes. Yeah, I mentioned it before. We're getting a lot more traction on YouTube almost by accident. I even forgot we had a YouTube channel. It's just one of those. Our distributor also puts it out via YouTube. And so all of a sudden we're getting all this feedback. We love your YouTube. Oh, that's true. We do have a YouTube. It's not even video, but people love it there nonetheless. So if you like to consume it, you want to consume Dan's while you're over there as well. Or, of course, check out the whole kit and caboodle, the mothership, Market Taker, 2 T's. Don't forget the 2 T's. MarketTakerMentoring.com, or actually just MarketTaker.com, is the place to go, listeners. And on behalf of Dan and Tony and indeed myself, I want to thank all of you out there for downloading, listening, subscribing, for listening live, and, of course, sending in such great questions. Don't worry, we'll get to more of you on the next episode, and we'll be back really soon with more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.